tax credit. It's a very interesting topic in the sense that many of you are seasoned tax practitioners and tax lawyers, and therefore have dealt with SENVAT credit to its fullest possibilities. And some are very seniors that they would have gone through the set-off procedure days from ModVat days to SENVAT credit days, and therefore they would know the in and out of how it has happened. There is also that professionals are also aware of how VAT credit behaves. And in that context, GST makes an interesting difference. And therefore, some of the topics that we're now would be of relevance. Next, please. I don't want to beat around as to why GST, ITC, and all those things, all enough done. So I'll go straight to the topic. So first of all, we are now having a definition which probably is the most simplest one and probably the widest one ever in the context of SENVAT creditors. Of course, we didn't have that provision in the context of the rules when it merged, Excise and Service Act when it merged in 2004. The business activities was there. There was quite an elaborate one. That got diluted again in 2011. If you look at this definition, not only used, but also intended to be used by a supplier in the course of furtherance of business. And this, in the course of furtherance of business, is going to be very, very wide. And business is also very widely structured in the definition. It also talks about not only any trade, commerce, manufacture, profession, vocation, adventure, wager, or any other similar activity, whether or not it is for pecuniary benefit, but also any activity or transaction in connection which is incidental or ancillary to subclause A. So business has been quite widely structured. So if I'm able to demonstrate that whatever I've purchased is used or it is intended to be used in the course of furtherance of business, then there ends the matter as far as my eligibility to claim credit is concerned. Now, typically, it is not as if we are not aware of what can happen, what can go wrong. When targets are set and revenue mobilization starts, then the easiest or the low-hanging fruit is the denial of the input tax credit or the early days SENVAT credit. And how could one deny that? One could probably deny that by saying that, no, it is not used for the purpose of business. No, it is not intended to be used for the purpose of business, or it appears to be unreasonable, or it appears to be excessive. Why do you want to spend 1 crore on a particular item when your revenue target, when your turnover itself is about 10 lakhs? These kind of questions are likely. Next slide. Capital goods, for the first time, is defined in a very different way. If you remember capital goods in the SENVAT credit rules, it was linked to the SENVAT credit rules whereby it was confined to chapter 84 and 85 and few other items. And one had to receive the goods in the factory. And of course, we had decisions on whether it should be in the factory or even outside is fine. But capital goods had interesting definitions in VAT law. In fact, I recall that the Gujarat VAT Act used to say that capital goods means capital goods as per SENVAT credit rules. And Maharashtra VAT Act used to say that capital goods means capital asset as per Income Tax Act. And the Karnataka VAT Act used to say that capital goods means such goods as may be notified by the commissioner from time to time. So we had ridiculous and ludicrous definitions of capital goods, which created its own controversy. Now in the GST, you have a much simpler definition where it says, are you going to capitalize this in your books of accounts? So an accounting plays a big role. So if you're going to capitalize this, and the decision to capitalize is not an individual decision, there are accounting principles and guidelines as to when you should capitalize and when you should not capitalize. So the goods are going to be capitalized in the books of accounts. It takes the character of capital goods. There is no impact as far as GST credit is concerned. The entire amount of GST is available as credit. You don't have those period of 2 years spread over, or the VAT days where some of the states even had 36 months spread over. Only catch is that if you're going to claim depreciation on the tax component, then ITC would not be allowed. This is by the simple philosophy that you cannot claim double benefit. So for let us assume the machinery is about 1 crore and the GST is about 18 lakhs on that particular item, then you need to capitalize 1 crore for the purpose of depreciation. So for income tax purposes, the actual cost will be only 1 crore and 18 lakhs will qualify as a GST credit. But if you decide that I want to claim the entire 18 lakhs as part of value for the purpose of income tax, then you have to forego the GST credit. And that's how it has been structured. And whether an expenditure is capital expenditure, revenue expenditure is its own version of income tax decisions. In fact, many of you seniors would know that whenever a decision comes as to whether an activity is manufactured or not, the decision will start at the first line that whether an activity amounts to manufacture depends on the facts of the case. So capital expenditure, revenue expenditure is also the same story. And there are decisions in the context of whether replacement of parts are more in the nature of repair and not necessarily capital. You don't have to capitalize some of the items. If that is the case, then it may even classify as inputs and not as capital goods. But it's a cost-benefit exercise. Whether you want more depreciation or you want less depreciation, it's basically a business call. Next. Coming to input service, again a mirror definition of inputs. Any service used or intended to be used by a supplier in the course of furtherance of business. The same, whatever I talked about in input is equally applicable to services. Next. Now, what is this nexus to business? As I said earlier, the nexus to business is much, much wider than the SENVAT credit and the VAT credit. Now, furtherance of business could also mean exiting another business. I have multiple businesses. I decide that viability is such that I may have to close down two businesses. For example, post-COVID, I may even decide to hive off a particular business. I may decide to do a slum sale of a particular undertaking. And when I do all that, I may engage consultants, I may engage experts, I may engage valuers, I may engage diligence analysts. And there could be a lot of GST which all these vendors and service providers would charge. Now, whether the GST which they charge is used for the purpose of business. So furtherance of business is quite wide. And therefore, even if I am exiting certain businesses to make my current business viable, there's nothing wrong in claiming credit compared to what it was before. Because manufacture was a critical point in SENVAT credit, but that is missing as far as GST is concerned in a much wider way. And it is not as if that business concept has not been tested. We have enough literature in income tax law where business expenditure has always been questioned, whether this expenditure is incurred for the purpose of business or not. Now you have the decision of the Supreme Court in the case of Walton, where Supreme Court said that it is not open to the revenue to adopt a subjective standard of reasonableness and disallow part of business as being unreasonably large. So whether an expenditure is excessive or whether the expenditure is warranted, whether the expenditure is relevant, or should you need to incur this expenditure or not, is entirely the prerogative of the businessman. For all you know, from a common man's perspective, this expenditure is not going to be fruitful. It is unviable. It is going to bring the company to a loss. Doesn't matter. It is his expenditure. He has incurred it. Does he have documents to prove that he has genuinely incurred the expenditure? Has he received those goods? Has he received those services? Has he satisfied the conditions of section 16.2? Then there ends the matter. He should be entitled to credit. Similar observation by the Supreme Court in Dandarajgiri, 91 ITR 544. Next, please. So, just a flash from the past to understand how the present is wide. In the context of manufacturers, the SENVAT credit was confined to a definition where you had to demonstrate a link to manufacture for some point of time. And even afterwards, when the law got amended and expanded, the link was brought back subsequently in 2011. In the context of traders, there was always a cascading effect because whatever was the excise duty charged by the manufacturer was always a cost to the trader. So as a trader, a retail outlet, when they buy the goods, the ED was a cost, and therefore that got built into the pricing. And the trader had a rented premises. The GST on the rentals could not, the service tax on the rentals could not be taken as a credit. The AMC credit could not be taken. The security cameras, gadgets, whatever was used, no credit could be taken. So traders had an inbuilt cost whenever they procured goods. If we look at service providers, they had a problem because the goods they buy had VAT, and the VAT could not qualify for credit. So if you look at it, in fact, I would even go deeper and say that if you go by the preamble to the 101st Constitutional Amendment, one of the objectives of the 101st Constitutional Amendment is to eliminate the cascading effect of taxes. So it is not as if that the GST is just another form of ITC. It is a superior form of ITC, whereby it has understood what were the problems in the earlier system and desired to eliminate the cascading effect of tax. And that is why we have a much, much better canvas in terms of definitions. But as far as decision goes, we have very interesting decisions in the context of excise. We had this fantastic case in Balarpur Industries, where somebody was making paper. And in the paper making process is quite interesting. Many of you would have actually viewed the process. You had this massive cutter where the tree would be cut, the wood would be cut, and this cut pieces would go through a particular format, like through a platform. It will land into a cooker, which will be probably 3-4 stories high, and the wood would be cooked with water. And while the wood is cooked, it will become so soft. It will be almost like cotton. It will be like a fiber. And the lignin is the element of wood fiber that will be prevalent in that particular cotton kind of thing. And that will be all aggregated and put in another vat where they will add chemicals to move the process faster. They will add talcum powder to make it whiter. And then you have a thickening kind of liquid, which would then be poured across a massive machinery, which has got rollers and plates and giant fans. So while this liquid rolls out like a milk flow, the fans will hit that milk, and that entire thing will become thicker and come out as paper. That's why when you look at the paper, you will see some strands, like some fiber strands or wooden fiber strands. Now, the question that came before the court was, fine, all this is fine. You claimed modified credit on that particular chemicals used in the paper. Where is the chemical in the paper? I don't see the chemical in the paper. I don't see the input physically in the output. And the Supreme Court went on to observe that the disappearance of the input is required for the appearance of the output. Brilliant observation, which kind of settled the dispute as to what would qualify as inputs. So we had decisions right from those days. Then there was this question in the context of Horlicks, where a person outsourced the cap instead of making the cap himself. And the question rose as to why did you outsource it? You could have made it yourself. Had you made it, I would have given you credit. All that was denied by the courts. And you had Pond's judgment on plastic granules and what is indirect inputs. What happens if items are lost in the course of manufacture? Take, for example, I'm making some kind of component which has got steel in it, and therefore I put a steel plate on the table, and the steel plate moves because of it is a moving machinery in terms of which enables the steel plate to move. And at the right point of time, the employee has got to press a button, and a plunger comes from the sky, and the plunger makes a beautiful hole, exactly 3 holes that is made in that particular steel plate, and the next steel plate comes. So this employee's only work in life is to correctly press the plunger and ensure that those 3 holes are punched out. The next steel plate comes on. At some point of time, what happened was this man got a WhatsApp message. And when the employee gets a WhatsApp message, like all of us, we tend to read it. And not only do we tend to read it, we get absorbed in it. We soak into it. And then we decide that this message should not remain with us. And with a great degree of enthusiasm, we forward to the rest of the world. So this employee is also equally adept at it. And when he was doing that, the steel plate that he kept was not properly kept. And therefore the plunger came and the holes were not proper. And that steel got rejected or completely thrown in the course of assembly. Now, is it a case of used in manufacture? Is it a case of loss during manufacture? Obviously, it has been used in the course of manufacture, but it was lost. But the courts have always felt that so long as you put them into use, you should qualify for credit. Then we had the decisions on fuel and electricity and usage outside the factory. So all these are now becoming a thing of the past when you're able to demonstrate that nexus to business is more than enough. Next. Now let's look at ITC and COVID. All of us, I think probably lawyers are equally embracing this work from home environment, though our work from home environment is very, very limited in terms of knowledge gathering and knowledge dissemination and looking at some emails and drafting some opinions. Definitely court work has not happened, and it's difficult to demonstrate an emergency to justify an admission at this kind of juncture. And the tax department is also not functional, therefore those kind of emergencies also don't exist. So typically, the rest of the world is working from home. IT is always known for working from home. Rest of the business are learning for working from home. Finance is being outsourced. Business support is being outsourced. So in all these cases, what is happening is that people are realizing that this could become a new norm. Work from home could be so efficient and so effective that companies could then decide, why do I need so much of retail space? Or why do you need so much of real estate space? I have a massive 10-story building in OMR, and I ferry all my employees by 100 buses in the morning and create traffic jam in OMR. Why do you need to ferry all these guys to this office and make them work? I pay rentals, I suffer air conditioning, I suffer maintenance, and so much of cost. Why not I cut down these costs because the same work is going to happen from home? That is an easy decision that can happen. And some of the news items like how TCS is talking about a significant work from home policies in the future is a clear indication. So not only IT, every other company will start looking at work from home as an option. But then work from home also has got risks. And what is the biggest risk is your security risk. Many of us are aware that Zoom has got certain challenges and certain protocols are required. But apart from Zoom, when an employee is working on company's data, there are serious issues in terms of how much of data can be used by somebody. There could be peering softwares which can look at it. And what is the technology which the employee has got in his house? For all you know, he'll be working on a Wi-Fi with a very weak password. Or he could be having a Wi-Fi password which the entire neighborhood knows. Or he could be working on a system which is also used for his by the entire family. So his son or daughter could be looking at a particular game which may have its own Trojan horses and things like that. Therefore, the risk of virus attack, the risk of a malicious attack, the risk of a hacking, the risk of data getting lost is significant. Therefore, what companies are likely to do is, this is my guess as going forward, I'm just predicting what's going to happen. Companies would start investing in equipments and devices and security systems for the employee also. So they would buy gadgets, they would buy certain special equipments, they would get some technology experts to install those services. They will ensure that higher level security for data is provided. They'll go by beyond first level encryption to second level encryption to third level encryption. They will enhance the firewalls. They'll do what all they can to ensure that data is protected. Now, all these are at the cost of the organization. So the company is going to get all these items, company is going to get all those services, and they will want the ITC on that. So you may have to implement build to ship to models effectively, whereby the ship to could be the employees' residence. There could be a lot of management issues in this, but it will happen. And then credit can be availed based on the invoices. Then there could be a third dimension whereby the employer could say that you incur all these expenditures. This is a budget. These are the identified vendors. You make the payment directly. I will reimburse the cost. Now, in that scenario, there would be an impact of GST, which everybody loses because the employee is not in a position to get the credit. And the fourth dimension would be that the company would also incur expenditure significantly towards corporate social responsibility. Corporate social responsibility need not be a mandated thing as per the Companies Act, while the Companies Act does provide for a mandate for certain companies under certain circumstances. And we also have the controversy as to whether the contribution to CM's relief fund would qualify or not. The answer is no as far as the schedule is concerned. But if the expenditure is identified towards disaster management, then it should qualify. But assuming the company is going on taking care of its own area, it is going to spend a lot of money on the surrounding neighborhood. It is going to ensure that food is provided. It is going to ensure that security is provided. It's going to provide health care across people. It provides so many ways, all kinds of expenses. Now, when these expenditures incurred and there is a GST element in those expenditures, can I claim credit? In my view, yes. Even though from an income tax perspective, any expenditure on CSR is specifically disallowed. That's a provision which disallows it. So in the absence of any kind of a disallowing mechanism, there is no harm in availing credit, even in respect of CSR, as well as other activities which are akin to CSR. Then there could be special insurance schemes that will get floated. Post-COVID, they will have new kinds of insurance policies. All of them will be relevant to business and should qualify for credit. Then the larger question that would be in the context of ITC is, the government orders are very clear that you should lock down, and therefore there is a stoppage of production. So does stoppage of production means that the capital goods are not being used or the inputs are not being used? Or that kind of absurd question can arise at some point of time. But then used or intended to be used is quite wide, and you should be able to continue to avail your ITC. And last but not the least is your delay in payments to vendors. There could be scenarios where you have vendors and you're going to delay payments because he does not come in the priority. You're paranoid about whether the order passed under the National Disaster Management Act is binding or not, whether a directive to pay wages under the National Disaster Management Act is superior to the Industrial Disputes Act or the labor law regulations. Matters are pending in Supreme Court, and Court has also taken cognizance of the petitions filed by both the union as well as the employer perspective, and matters stand urgent. So in this scenario, people may not take the risk and they may start making payments to employees first. If that is the case, then vendor would come last in the list. And if vendor is going to come last in the list, then you have this 180 days window in GST. If you don't make the payment to the vendor, you can't avail the input tax credit, or whatever you avail, you must reverse. So there will be some kind of impact on ITC reversal. And companies may even be forced to take a call that reversing ITC is much better than paying the vendor because I need the cash flow for other aspects. So these are some of aspects of COVID which I thought we shall share as far as ITC is concerned. Moving forward, let's go to the technical part of GST credits. This is nothing but a translation of Section 16.2. So Section 16.2 mandates that a person is in a position to avail input tax credit if 4 conditions are satisfied. He must possess a tax invoice or a debit note or such other prescribed document. So this a prescribed document would be a different scenarios where even a bill of entry would fall under the prescribed document in the case of import-related IGST. The rules cover a list of other documents. Second, I must receive the goods. I must receive the services. Now, receipt of goods is something which can be demonstrated. I can have a GRN as soon as the goods walk into my factory. Receipt of services might be a challenge in the future. It could be difficult to prove in certain IT services as to how we receive the services because there may not be a sign-off at all. But still, payment is a decent proof that I've received the service, and invoice could be an adequate proof. Then the third one is a challenge. Tax charge in respect of supply has been actually paid to the credit of the government either in cash or through utilization of admissible ITC. Now, how do I know? I have received a BSNL telephone bill. I have seen the GST in the telephone bill. I have taken the GST credit. I have paid BSNL. How do I know whether BSNL has paid this bill or not? You mean paid the GST or not? And how, even if BSNL is kind enough to share the returns, how will I even decipher whether he has paid or not? Of course, people come back with the answer saying that, no, you have the GSTR1, the GSTR1 will come into your GSTR2A, the GSTR2A is approved and all those things. I have my reservations on that. I'll come back to a bit later. But this is what the section says. Section talks about 4 conditions. The first 2 conditions and the last conditions are definitely compliable conditions. The third condition appears to me as an onerous condition. Therefore, the question that can arise is whether the third condition can be questioned in a court of law. Next. So this has been challenged. Conditions requiring the buyer to verify whether supplier has paid the tax to the government account has been challenged with Delhi High Court in the case of Bharati Telemedia versus Union of India. And then if you look at some of the other precedents on this, cannot be direct to GST, but you had this in the context of VAT, where the Madras Tax Bar in Vinayak agencies held that the department is not empowered under 1916 to revoke ITC avail on the plea that the selling dealer has not paid tax when the petitioner dealer has paid tax to the selling dealer and ITC by way of self-assessment. So that is an interesting observation of the Madras Tax Bar when they say that the buyer has paid the vendor, the buyer has got the invoice. What more proof do you need? If the seller has not paid, that is a problem between the seller and the revenue and not the buyer. Next. In fact, in Arise India, very interesting decision of the Delhi High Court where they applied the doctrine of impossibility. So the doctrine of impossibility basically stipulates that a man cannot be legally compelled to do what is impossible. The law cannot compel him to do what is impossible. And therefore, Section 9(2)(g) of the DVAT Act was questioned, and the court read down the provision by saying that it will not cover a purchasing dealer who has bona fide entered into a purchase transaction with a validly registered selling dealer who has issued tax invoices. So at the time of procurement, I need to do some kind of diligence to ensure that my vendor is genuine, my vendor is bona fide. I look at the website and I find that he's alive, his number is valid. And basically, based on the transactions, I get the invoice, I get the goods, and I claim the credit. Beyond that, I cannot do a CBI investigation to find out whether my supplier has paid the tax. Next. Contra view, Bombay High Court in the same kind of scenario, same kind of VAT provision, they took a contra view and they upheld a provision which required such kind of an onerous condition. But my question would be, can filing of GSTR1 be a condition for availment of ITC by the recipient? Can payment of tax by the supplier be a condition for availment of ITC by a recipient? Now, if you look at section 16(2), the filing of return is in the context of the user or the receiver and not the supplier. But many have read that the 16(2) should be governing a supplier. But 16(2) covers a person who avails the ITC. So when the word used is he has furnished the return, the he there refers to the person claiming the credit and not the supplier. Therefore, insisting that the supplier should file a GSTR1 as a precondition for the buyer to avail the credit is definitely questionable. Next. Now let's look at the other next level dimension of ITC. Now this is again, I will just stop for a moment and try to understand the government's thinking behind all these things. Now, why does the government do all these things? Or why does the rule maker decide that they will give these kind of provisions? For that, we need to go back in terms of ModVat itself in the past. When VP Singh brought ModVat, in fact, if some of you remember the budget speech of VP Singh, when he brought the ModVat or the modified value added tax, he jokingly said that this is not MadVat, this is ModVat. But in reality, it turned out to be MadVat. The sense that show cause notice was issued across the country on various aspects saying that this is not an input, this is not used in manufacture, this is not found in manufacture, this document is not there, third copy is not there, second copy has got a problem, first copy has got some smudges in the corner, full date has not been put, signature is not proper, address is corporate office, not factory office. All kinds of issues were raised. Why? Because the moment you avail ITC, then you're going to use that ITC to pay the GST or the excise as the case may be, and therefore the collection comes down in terms of taxes. But that is the philosophy of this. The whole philosophy of GST is that you must have increased the tax base. You should have increased the tax base by bringing many assessees into the fold and ensure that you have a smooth, seamless tax credit. not seemingly less credit. You must have a seamless tax credit where everything flows from A to B. You can't tax everything on the right side without giving credit on the left side. But what happens is that when the revenue shortfall happens, then the government immediately decides that we have to look at something. We need to look at the ITC. Why not question the ITC? So that is when they started to look at ITC and then start these numbers, etc. Of course, they were also worried by the fake invoice racket. The fake invoice racket is definitely a terrible racket which hit GST. But going by world experience, India is not the only country which is going through a fake invoice racket. Every country that implements VAT or GST has got this. They call it a carousel game in EU VAT. So you have people who have multiple names and multiple address, and they keep on circulating. So every jurisdiction has faced this kind of a problem. So if there are 100 SSCs and 10 of them are bad in terms of claiming these ITC in terms of fake invoice, etc., the law cannot become difficult for the rest of the 90. The law must be much more practical in going about how it implements. Take whatever action you want against the 10, but ensure that the law is also smooth for the rest of the 90. But unfortunately, the 36(4) is a complete opposite of all that, where it tries to say that how much of difference between people who have not uploaded and in terms of people who have uploaded. They said there should be a cap of 20% of eligible credit. So you're supposed to compare your GSTR 3B, which is the return which is the document that you file, which is now classified as a return, and you're supposed to compare the 3B and the 2A, and the 2A hinges upon the 1 being filed. And GSTR 1 is a document which is in your hands. The supplier is supposed to file it. Then after a lot of representations, the 20% became 10%. So now, after the COVID-related problems, there is another notification which said that February 20th to August 20th, we look at some kind of relaxation, and you do a cumulative adjustment in your GSTR 3B in September 2020. Next. And immediately after this rule came, the board issued a circular saying that, look, this is a new provision, and this is not a restriction which is coming through the portal. And therefore, SSC has to take care and ensure that he properly avails the credit and follows the applicable rules. Now, the question is whether 36(4) has got its origin to section 16(2). The answer is no. So whether 36(4) itself is valid. Next. Source of power for a rule which refers to a ceiling limit of 20% in the context of suppliers who have not uploaded the invoice data. The only possible reference I can see to 20% is section 43A. 43A was brought into the statute books by the CGST Amendment Act 2018. The object of 43A was to get into a system where invoice matching would happen. You will have to file the invoice, supplier has to file the invoice, you will have to verify the invoice, you have to accept the invoice, and based on the acceptance rate to be taken. And if something goes wrong, there was a joint and several liability on both the supplier and the buyer. And 43 had its own subsections which empowered the rule maker to prescribe an outer limit, namely this kind not exceeding 20%. But section 43A was never notified. It was never brought into force because the system was not ready. You can never implement 43A. Of course, they did try invoicing through other websites, but 43A was a huge challenge. In fact, the latest press reports indicate that they may defer this invoicing system for some more time because now is not the best time to implement any of these things. Therefore, if 43A has not come into force, is 36(4) valid? Because 36(4) can owe its origin or owe its power only to 43A. So in the absence of a clear and natural source of power, the rule which provides for a restriction cannot be considered as valid. And if you go back to other provisions, section 16(2) does not provide any power to restrict credit. And best, if at all, there is a section which deals with restriction, that is section 17, and that doesn't cover this. Next. Now let me go to the bigger segment in GST, section 17(5). In fact, I don't understand section 17(5). When we think of a situation where we want to give credit for everything, this obsession to say that I would restrict credit on certain items seems to be very, very contra to the overall objective. Of course, early days, probably government might say that let our GST collections improve, we'll probably give you the ITC. But the GST collections could not improve because there were economic factors, downturn factors, and the government kept reducing the rate of tax. And after having a 37% effective indirect tax, you can't come down to 18% and still expect revenues to happen. And therefore, it is not easy unless you get new businesses, and new businesses are not easy when the economy is not so great. Therefore, the GST had its own chucker. It went through its churns, but by the time it peaked into good journeys, this COVID has also happened. So let's look at some aspects of block credits, as I would call it. One, it says no credit on motor vehicles for transportation of persons having seating capacity not more than 30. including driver, except when, the exceptions are most important. You are using the vehicle for supply of vehicles, which would cover all the traders and the dealers. You're using the vehicle for transportation of passengers. You're using the vehicles for imparting training or driving certificates. And then they also added that insurance, servicing, repair, maintenance, insofar as related to motor vehicles, are also not eligible. But this amendment of insurance, servicing, repair, and maintenance came only from 1/2/2019. That was the effective date. Therefore, the question that could be is, what happens to the past period? Am I eligible for that? Next. Can ITC be claimed on motor vehicle repairs, maintenance, insurance prior to 1/2/2009? The language used before was in respect of motor vehicles. Now, Supreme Court in the case of Swastik Tobacco has held that in respect of is synonymous with on. Therefore, GST on motor vehicles is very different from GST on the repair involving motor vehicles or insurance involving motor vehicles. Motor vehicle is a species by itself, it's an asset by itself. Therefore, GST on that, I'm not eligible to claim prior to 1/2/2019. But insurance services is provided by an insurance company who is a service provider. Maintenance is provided by another company where his service itself is declared as a service in the CGST. Therefore, it's a supply of service and not even supply of goods. Therefore, in respect of motor vehicles cannot be extended to cover repairs, maintenance, insurance prior to 1/2/2019. Therefore, somebody should be in a position to claim credit. Of course, litigation will follow and courts will have to resolve the problem. Next. Then you don't have ITC in respect of vessels and aircrafts, except when they're used for making same three exceptions. Fourth exception is also transportation of passengers, supply and training and navigation. Next. So a couple of questions. Can I claim ITC when I use aircrafts for my company? I'm quite a big company. It's got multi locations, it's got multi plants, and it's got a Dornier aircraft or a Cessna aircraft, and they decide to fly their executives, directors, and save time and move across the country and move across the world if required. So can I claim ITC on the aircraft purchased by the company? Or can I claim ITC on the maintenance which I incur or the insurance which I incur on the aircraft? Or a situation where an airline, of course, airline is not the best example now because none of the airlines are flying and we don't know when they can actually take off. Can an airline claim ITC on both economy as well as other than economy tickets? This is because economy has got a lower rate of tax without ITC on aircrafts, whereas business class other than economy has got a high rate of tax with full ITC. So is it possible for me to claim the full ITC? Let's try to explore some of these questions. Next. There is a decision in the case of Global Vectra Helicopter, where the tribunal held that if the services provided to various companies who charter the aircraft for a specific time for a specific journey, the payment is not based on number of passengers. No tickets are issued to the passengers. No charges are collected from the passengers. And therefore, it is not a case of transportation of passengers, but should be charter of aircraft. Now, this kind of decision used to come in service tax because service tax had this categorization of services into taxable services. There were definitions for taxable services. Before 2012 was brought in effectively as declared services, we had enough decisions in service tax as to whether a transaction is transfer of right to use goods and therefore a sale in terms of Article 366(29)(a) and kept out of the ambit of service tax, or whether a transaction is a supply of tangible service where effective control and possession is the key factor. So that kind of legacy was there, and therefore decisions arose as to whether you can say that there is a transportation of passengers when the company's executives fly in the company's aircraft, and that is the decision of Global Vectra. Next. The term passenger came up for interpretation in another case called King Rotas, where the tribunal held that the word passenger refers to natural persons, and when an aircraft is chartered by an offshore oil company to ferry their personnel, the aircraft is used by independent third parties, namely the offshore extraction company, and therefore they said it cannot be considered as service provided to passengers. But I have a different view, this because these decisions were in the context of, as I said, classification. In the context of GST credit, I should demonstrate that the aircraft has been used for transportation of passengers. Now, I go to Civil Aviation Ministry, I go to DGCA. There are strict guidelines as to who can travel my aircraft. Next. An employee remains a human being, and the employee remains a person who goes by the aircraft. And when an aircraft is taking off from one point to another point, the employee in that point of time becomes a passenger. And when an aircraft takes off, whether for a private purpose or otherwise, you need flight plans, you need a passenger manifest, you need security, you need all the same things that are applicable to every other person. And there is a DGCA air transport circular which said that private aircraft owned by companies can be used only by the employees, including chairman and members of the board of directors, and others as only they can be permitted as passengers. So even DGCA recognizes them only as passengers. Therefore, it should be possible to make a claim as far as ITC is concerned in respect of these elements. Next. Next board blocked credit segment is, there is a restriction that says you cannot claim credit on food and beverages. Now, my doubt is this. The food and beverages seems to indicate that it is goods, supply of goods. Whereas, when I go to a hotel and have a meal and I get a bill, now thanks to the schedule of the CGST Act, Schedule 2 specifically, the supply of food or beverages, whether as such or part of service, is identified as a service. So if you read section 7.1a, read with second schedule, 7.1a says that if there is a transaction which is supply in terms of 7.1, it will be identified as either a supply of goods or supply of services through Schedule 2. Therefore, Schedule 2 has become a classification mechanism where restaurant and hotels are identified as supply of services. So when there is a restriction on food and beverages, should we assume that restaurants are covered, or shall we take a stand that restaurant is a service by itself? Therefore, I'm availing only on services because the rate of tax is through a service notification. As you all know that goods and services are dealt separately in GST. 1/2017 covers goods and 11/2017 covers services. Goods and services are well defined. Place of supply for goods is different. Place of supply for services is different. Therefore, if the Parliament has chosen to treat restaurant as a service provider, who am I to consider that what I consume in the restaurant becomes food and beverages? Therefore, is it not possible for me to claim ITC on restaurant services? Or let us imagine a situation where a consultant, because lawyers are not liable to GST and it's under reverse charge cancel. Let us say a chartered accountant decides that he buys a coffee powder and he's got coffee making machines inside his office and he makes his own coffee. Now, can you say that coffee is food and beverage, therefore it doesn't qualify? Next. Just to buttress the point, food and beverages, outdoor catering, and outdoor catering is a service. Therefore, they've chosen to specify outdoor catering as not eligible, but restaurant doesn't find place in that list. Again, what is food can be a matter of debate. Some of you would remember that in the service tax law, since food was kept out of the ambit through a notification, there was an explanation which defined food, and it said food is a substantial and satisfying meal. A very tricky definition, because substantial and satisfying are always prerogative of the person who consumes and not the person who provides. And that's what it's and has been used in the conjunctive sense. In fact, there is one decision also, I think it's Bangalore Tribunal or something, where somebody served sandwiches and tea and some kind of cake and claimed the benefit that it is a satisfying meal. And the department denied that, saying that this is not a full-fledged meal. But the tribunal ultimately said that high tea is the modern equivalent of a meal. And therefore, they allowed the claim as far as exclusion is concerned. Next. Now, going back to my question, can coffee powder be considered as food? You have an interesting decision in the case of pan chutney. You're aware of the days when, before lockout, when people used to stroll around and walk around and go to a pan wala and stand there and ask for a pan. And that man would fish out a beautiful betel leaf and then dip into a pan of water or a bucket of water. God knows how many times he has washed it. And then he would apply one kind of a brown liquid. That is a pan chutney. So the question is whether pan chutney is an edible preparation or not. So where the Supreme Court said pan chutney is definitely edible, sauce or a ketchup is an accompaniment to food. Pan is not food, though it may be edible. And then they define what is a food. They said food is a substance which is taken into the body to maintain life and growth. And therefore, they said sauce is only an accompaniment. Since pan is not a food, the chutney which is an accompaniment would not fall in 210311. Therefore, a coffee powder may not qualify as a food, though many of us who love coffee would probably say that we are desperate for a particular coffee. But definitely coffee is not food. And therefore, if coffee is not food, it is not falling under the first exclusion. Second, it is not a beverage because I bought only a coffee powder and I'm making the beverage. Therefore, technically, somebody should be able to make a claim as far as ITC is concerned. Next. Going on to the bigger segment in block credits, I'll pick it with 4 questions. Can a developer avail credit of the GST charged by the contractors? Obviously, the answer is yes, subject to so many other caveats. Can a developer avail credit in respect of GST charged by suppliers of services? Can a contractor avail credit of GST charged by subcontractors? Can a mall avail credit of the GST charged by contractors for a building its mall? Now, why do these questions come up? Next. These questions come up because of the language used in section 17.5c and 17.5d. 17.5c says, works contract service when supplied for construction of an immovable property, other than plant and machinery, except where it is an input service for a further supply of works contract service. So typically, if I'm engaged in providing works contract service and I engage a subcontractor who provides works contract services, that should not be a problem. If I'm a developer, I should also be eligible for credit, unless I'm gotten one of those notifications where I've chosen a particular rate of tax, which says that I may not be eligible for ITC. I'll come to that notification a bit later. Then second is, goods or services are both received by a taxable person for construction of immovable property, other than plant and machinery, on his own account, including when such goods or services are both used in the course of furtherance of business. So this obviously impacts straight away factories, warehouses, godowns, theaters, malls, and commercial buildings. So the owner of a mall, when he buys a cement, he would get hit by the second category. The owner of a mall, when he engages as a contractor, he will be hit by the first category. Next. So the larger question is, what is immovable property? Now, fundamentally, if you look at the entire law, immovable property is not defined. If you look at Transfer of Property Act, immovable property is defined in a very peculiar manner. It excludes standing crops, etc. Therefore, you have to look at the General Clauses Act, which is very well structured in terms of what is immovable property. And typically, the way that it is used, it is embedded or embedded to the earth, etc. In fact, way back, we had all these disputes in the context of excise. And since some of them are, some of you are young participants, I'll just give you an example of understanding what is immovable or what is not immovable. So let me take an example of a kitchen. Now in the kitchen, you have the mixie, and you're making chutney for breakfast, for your dosa and the breakfast. And you put a particular jar, you put all the ingredients and make the chutney. Now after a couple of rounds, the chutney is done, you remove the jar, and then you decide that I would like to have some juice. And therefore you take another jar and put it in this particular mixie. So the very fact that you're able to seamlessly move and remove one jar and keep another jar, keep that in mind. Now, assuming the chutney jar cannot be taken out of the mixie unless you bring a hammer and a screw and hit it from all sides and swivel out the entire jar, then that mixie is completely useless as far as that next jar or next activity is concerned. Therefore, you have to understand that from an immovable property perspective, what the courts looked at is it such that it has become part and parcel of the immovable property? Is it merely fixed for purpose of operational efficiency? Or is it, what is the object of annexation? Why is this particular item annexed to the earth? Then the next question is, what is the degree of annexation? So if these questions are examined, so if you imagine a situation where a huge plant is put up and the plant is very much fixed to the earth, and for some reason you have to take out that plant, you may end up damaging the plant. Of course, you don't have to open and show that I have to damage the plant. If you can demonstrate that the nexus to immovable is significant, it will become immovable. But on the other hand, if it is just like that, you remove a couple of screws and bolts and nuts and you can put it into a lorry and take it to another site and install it, then it becomes a movable property. This is how excise are always interpreted, and there were decisions based on this. Of course, we did have a controversial case law in the context of excise, in the sense that for a long period of time, solid engineering and other judgments were very clear that anything embedded to earth was immovable property. Then we had this new case law called as Sirpur paper mills. In Sirpur paper mills, it was a massive machinery. The size of the machinery is probably the size of a railway bogie, and it made tremendous amount of noise. And it also, when you have multiple parts in a machinery which also move, then the machinery tends to also move, pure mechanics. And therefore, to ensure that the machinery remained with them, they were quite possessive that the machinery should not go to the factory. They decided to fix some nuts and bolts into the earth and ensure that the machine had a wobble-free operation. That is a language that is used in the Supreme Court judgment. So Supreme Court said, since the object of affixing the machinery to the platform is only to ensure its wobble-free operations, it is more in the nature of a movable and not in the nature of immovable. But subsequently, in the case of Triveni Engineering, the Supreme Court did not agree with Sirpur Member Mills and said that they prefer to follow the earlier judgments and concluded that it is immovable property. So after that only we had this massive excise circular on power plants, cement plants, roadways, escalators, etc. But basically, the point I'm trying to drive is, today every company has got this situation as to whether it is a works contract or a composite plant, whether composite supply, whether it is a plant or not, whether it is immovable property or not. Because you have all kinds of questions coming up in terms of restriction in the hands of the buyer. The buyer keeps on saying, this is not immovable property, I will be entitled to credit. The supplier says, I will treat as works contract, I will charge you 18%. The buyer says, no, split the invoices, show supply separately, show services separately. So all kinds of disputes in this context. In fact, if you want a deeper study, you can go and hunt around for an old Madras High Court decision. I'm not able to remember, 1950s, where projector was the issue. The projector was being taken around in the city, around the town, and the projector was affixed to a particular tent for showing the film. And the question arose as to whether the projector has become immovable or not. There is also another Madras High Court judge in the context of a mortgage case involving a theatre building. And the question was whether the entire building has been mortgaged or it covers even the various special sealing which was done to ensure that noise does not go out. Then the court made a distinction between fixtures and said English law of fixtures does not apply to India. So there are a lot of interesting judgments on what constitutes immovable property. And some on the Transfer Property Act will also give you some kind of idea. Next. Then the best decision, from an interesting decision perspective, I know, Council for Revenue, some of my friends from the Revenue also, they may not like when I say it. It's an interesting decision. But it's an interesting decision in the context of how the provisions have been made. So Orissa High Court decided that how can you have a section which denies the ITC? Can you have a section which completely denies the ITC when the whole objective of the GST seems to be to provide ITC? And therefore said we cannot have such a narrow construction as 17.5D. When somebody puts up a mall, why does he put up a mall? He puts up the mall to generate revenue. His objective is to let out that various units and outlets to tenants. And on the rent, he's going to pay GST. Therefore, his whole objective of creating a mall is to create an infrastructure would become a revenue spending apparatus, and that revenue are going to tax it. And therefore, whatever goes into creation of that mall should qualify for credit. And that should be the interpretation of the provisions. And therefore, if a section says to the contrary, you will read down that section. And therefore, the Orissa High Court read down and said that credit should be available if you look at the language of the principles or the language in Asia Motors, since the purpose of credit is to give benefit to the SSC. You have to read this judgment in the context of the preamble to the 101st Constitutional Amendment. Then it would make sense. Of course, the matter is now pending in appeal to the Supreme Court. Revenue has gone on appeal and the matters are yet to be heard. Because supposed to be heard in February, but it did not happen. Will probably happen much later. Next. Then we have another restriction which says, if you give gift to employees and the value exceeds 50,000 rupees, you will not get the credit. Similarly, if you give to there are scenarios where you may give a gift to dealers and distributors, where it is given as free of cost, FOC. Now, why do you give gifts to dealers and distributors? I'm not talking about certain specific industries which may have certain objectives which is alien to ethics and law. I'm talking about generally companies which recognize and reward achievement of targets. A dealer could achieve a target and therefore he may be rewarded by a gift. A costly watch could be given or some kind of music system could be provided. And these would have GST when it is put to. So can I say that when I give these items, even though I'm giving it as FOC, I'm not paying GST only because I'm giving it as FOC, but my nexus to business still remains. So what is a gift? Gift is defined in the Transfer Property Act, whereby it is a transfer of certain existing movable or immovable property made voluntarily and without consideration by one person called the donor to another person called the donee and accepted on behalf of the donor. Therefore, what is critical is it must be without consideration. Consideration is alien to gifts. Therefore, if one can demonstrate that the reward or the benefits that I give in the form of tangible items is in lieu of the consideration of the distributor or dealer achieving certain targets, achieving certain phenomenal milestones, and therefore it loses its character of gift, then I could very well say they are not following the restriction. Next. Then we have the definition of, we have the concept of exempt supply. Exempt supply is in the way it is defined is that it is not liable to tax through a notification. It's fully exempt from GST, unlike the earlier system where even partially would get covered. Now, if I have exempt supply as well as taxable supply, then section 17(2) comes to the picture, and it says that where goods are used for effecting taxable supplies, including zero-rated supplies, and partly for effecting exempt supplies, credit shall be restricted to so much of the ITC as is attributable to taxable supplies. This is the avatar of Rule 6. The only difference is that Rule 6 was part of Senvat credit rules, whereas 17(2) is part of this Act itself. So one critical point is, for 17(2) to apply, one can possibly interpret that goods or service must be used for effecting exempted supplies. If Rule 42 says something to the contrary, then it may not prevail in the sense that 17(2) language will obviously prevail, and rule is only subsidiary to the section. So if I can demonstrate some goods or service were never used for an exempt supply, but I've used in my business, then I should be eligible to claim the credit. Next. Quickly, I'll pick up two sectors where ITC is a controversy. One is a hotel and restaurant. So take the case of hotels. You have the company employee traveling all the way from Chennai. He goes to Mumbai. He goes and stays in a hotel, marketing work for 3 days, and comes back. The hotel raises a bill. And since place of supply provision for services recognize that in the context of accommodation, it is a location of the immovable property, then the hotel decides that they will charge CGST and MGST or Maharashtra GST. Now, obviously, the company in Chennai cannot claim credit because MGST will definitely not qualify for credit. But I don't see any reason why they cannot claim credit of the CGST. The only challenge is that the portal will not allow. So this is something like the earlier example of Sami and Pusari. Even if law is regarded as the Sami, the portal becomes the Pusari, which can deny the credit. So somewhere something has to be changed because CGST is a central law. There is no reason why you should have a state-wise implementation of GST and say that even the CGST charge in Maharashtra should not qualify. There must be some mechanism where I should get at least a CGST credit. I can understand why I have not given the MGST credit because that goes to the state. Now, coming to the second aspect of hotels, there could be situations where the hotel has got a restaurant and the restaurant is charging 5% without ITC. And then it has got hotel accommodation where it charges 12%. I can't but recall the controversy that happened for that tweet, which that, what is that guy's name? The Bose, that Rahul Bose, who was an actor, who decided to stay in a hotel. And then one fine day, he decided to call room service and ask for bananas. Now, when he calls, if you stay in a 5-star hotel and you ask for bananas, you will get bananas in a very sophisticated manner. Therefore, the bananas came beautifully cut. It was in a lovely, clean white plate. And on top of it, you had a lovely plastic, which will never be biodegradable for millions of years. And this man got the bananas, and along with it, he got the bill. And he was shocked by the price of the bill. You should know when he was staying in a 5-star hotel. He was equally shocked by the GST charge on the bananas and promptly took a photo of that bill and tweeted, saying that this is what is happening. I'm being charged excessively on bananas as well as GST is being charged on this. It became a huge issue because the tweet became viral. It was retweeted across the world. And therefore, government also got into action and started questioning the hotel, saying, why did you charge on the bananas? And the hotel was also taken, some kind of action was taken against the hotel. But I only sympathize with the hotel because let's visualize this kind of situation. Let's imagine a hotel where you have a room where the tariff is above a particular threshold and therefore it attracts the highest rate of GST. And the moment you have a room which has got the highest tariff with the high rate of GST, your restaurant also qualifies for a higher rate of tax. Now, assuming you are saying that the banana is given as part of room service and room service is incidental to accommodation, then rate of tax will be higher. Or assuming you say the restaurant has provided the service and therefore the restaurant service and the GST applicable restaurant would apply. How does it become a sale of bananas by the hotel? The hotel might have bought the bananas in the market. That would be a supply of bananas to the hotel. But if the hotel takes from the restaurant and starts serving it, then it becomes impossible to say that it is not part of the service which is provided by the hotel. And then becomes a challenge. Assuming because of all this legal action, the hotel decides not to charge GST on bananas, I'm sure a few years later they'll get a show cause notice saying that, why did you not charge GST on bananas? In fact, I wrote a blog somewhere on a lighter note saying that in future, if somebody calls room service and asks for bananas, the first question the kitchen will ask is, the reception will say is, let me transfer the call to the kitchen. The kitchen then says, let me conference the call with our GST consultant. And why do you want the consultant? No, let's be safe. Then the consultant also comes on the line. And then this person asks a question, I want bananas. Do you want them peeled and cut or we want them as such? Of course, I want them peeled and cut. What kind of a stupid question are you asking? No, we need to be clear. We'll provide the bananas peeled and cut, and we are not going to charge GST on you. Along with the invoice, we'll also give an indemnity whereby you will undertake that in the event of the department taking a position that the banana supplied attracts GST, you shall reimburse along with interest. So that could be the kind of situation where even for an ordinary order of bananas, you will go bananas. So that is as far as hotels and restaurants are concerned. The third aspect of hotels and restaurants is that, let us say you have a bar. Of course, now all bars are locked down and everything is closed. But suppose you have a bar, then the alcohol is attracting that. Now, if you're going to order a glass of wine or a bottle of beer, along with that, if you order masala peanuts or some other snack, then the snack or the peanut might attract GST, while the wine or the beer would attract VAT. Imagine the credit management which the company has to do: VAT perspective, GST perspective, restaurant no ITC, accommodation ITC, banquet hall no ITC, with ITC, catering no ITC, all kinds of challenges. And that is a story as far as hotels and restaurants are concerned. Next. These developers were facing all kinds of problems, and they felt that they need some kind of relief. And the government also felt that developers are not, will have to be given some kind of friendly tax treatment. I assume, I abhor to think how it is a friendly tax treatment, because this notification 3/19 is a masterpiece by itself. Many of you would have read 3/19, many of you would have interpreted 3/19. But 3/19 it's almost, you need Konar note separately for understanding 3/19. So 3/19 is a bundle. It is a rate of tax notification, it is an exemption notification, it is a condition notification, it tells into GST credit, it decides to take penal action, all kinds of things are there. But many developers have chosen that notification as well as gone into it, whereby they say, okay, I will take a flat effective 5%. I'm skipping the abatement part of it. I'm saying 8% the effective rate, I factor the abatement and pay 5%. I don't avail ITC. Now my question is it mandatory? It ceases to be mandatory the moment, let's go back to basics. A GST rate flows from section 9(1) of the CGST Act and section 5(1) of the ITST Act. Nowhere in 9(1) or 5(1) you have powers to prescribe conditions. A rate of tax with conditions is very peculiar. Central excise tariff was different because there was specific provisions, and even in central excise tariff, they had a 5A through which exemption notification is given with or without conditions. You can give an exemption notification with conditions. You can give an exemption notification without conditions. That is why if you see 3/19 or for the matter 11/17, wherever they put this condition saying no ITC, you will always have a baggage. Along with section 5, you will also have a reference to the power which confers exemption. That means you will probably have to read 5% as an exemption or a concession without ITC. And therefore, condition for 5% is that I don't avail into tax credit. And it is a well settled judicial principle that if it comply with the condition and go to the full rate. Therefore, it may be possible for somebody to say that 5% is not mandatory. I will go for the normal rate. Or somebody could say that land I will treat as separately as sale of undivided share of land, and the construction contract I will continue to pay 18% as per the contract. Both are still possible. There is no hard and fast rule on 5%. Second, can a mere issue of CC warrant reversal of ITC? Now, I am doing a project of 100 apartments and I've sold about 10. 90, I have some monies, I've borrowed some monies, I've got some funds and I'm flushed with funds, therefore I decide to finish the construction full stroke. Now, if I finish the project and get a CC, just because I get a CC, can you say that there is an exempt supply and therefore there is a reversal of ITC? First of all, for exempt supply, there must be a supply. Is there a supply when I get a CC? And secondly, where is the consideration for an exempt supply? Of course, you will say that there is a notification that says that as soon as you get CC, you must reverse it. But I'm going to the root of the issue. Can there be a notification which says something is an exempt supply? And the statute does not even recognize this as a supply. So, sale of flat after CC, again the same question. Similarly, can there be a 5% for customers and 18% for landowner share? Should be possible, because for the landowner, I'm doing a construction. The land is already owned by him. Therefore, it is very well possible for me to say that what I'm doing for him is a construction and I would charge 18%. Of course, subject to a position which the developer can very well take based on the Vasantha Green principle, that the cost that I incur for construction of apartment for the owners is already captured in the cost which I incur for the price which I charge for my other customers, and therefore I pay GST. But the Vasantha Green would hold good in GST or not, we'll never know at a later point in time. But I'm saying that the via media could be that you adopt 5% for customers and 18% for landowner share. You will be able to take at least some amount of ITC. So I think this is one of my last slides. The last slide, yeah, open issues is the last slide. What is an exempt supply is a big issue. It will probably get settled by courts over a period of time. I don't think invoice matching is the best solution, though the government moves on invoice matching. World over, the experience has not been great. Whichever country has gone in the route of invoice matching has not been successful. The right approach would be probably effective audit, identify who are your biggest revenue spinners in GST, where is your maximum revenue coming from, which sector is contributing significantly GST to you, do data analytics, and then find out what kind of controls and mechanisms you can have to supervise that their compliance in terms of ITCs, instead of going behind every invoice matching, to waste time in doing that. Then the last is refund of ITC on exports. As an export, in fact, I've sent my recommendation to the government also to say that why have a situation where you should procure goods on payment of GST, avail ITC, export, and then claim refund. In COVID, cash flow is going to be the king, working capital is going to be the king, and therefore, why should I block my money by upfront paying, availing ITC, and then waiting for refund? Why not go back to the old excise pre-GST regime and say you can procure goods and services without GST if you're an exporter, and also make suitable amendments to ensure that the supplier who supplies to an exporter makes a zero-rated supply. Therefore, you will not deny the ITC to the supplier. It won't be an exempt supply in his hands. The exporter will be able to get goods without a cash outflow, and he will continue to export, and therefore you can do some kind of relief as far as COVID is concerned. Non-availability of ITC we've already discussed. Rule 42 and 43 is another major matrix by itself. You need a lot of you need English skills, you need mathematics skills, you need astrology, you need so many other skills to understand 42 and 43. But it is not so difficult to navigate. Once you have certain numbers, it should be possible to navigate with 42 and 43. So, dear friend, these are some of my thoughts on this exhaustive subject of input tax credit. That is my last slide, and thank you. If there are questions, I would be glad to take some of the questions. Wherever possible, I'll give answers to questions. If they are very technical, I'll probably skip them.
Thank you very much, Vaitheeswaran sir, for giving us such a lucid presentation on the concept of ITC in GST, sir. Sir, just before we take up the question, sir, I would just want to inform all our participants that today this is our 25th webinar which we have conducted. We started on 11th of this month, and then today we have finished 25th. And we thank Vaitheeswaran sir and Jay Kumar sir for requesting Vaitheeswaran to conduct this session today. I think it is it couldn't have been in a more better way than to have Vaitheeswaran sir to take a 25th seminar today. Thank you very much, sir. Sir, with your permission, we will take up a few questions. There are already a few people raising their hands. Aparna, ma'am?
Yes. Why do you start with me? Vaidhi, that was a brilliant presentation as usual. Just one question. I mean, it's just a discussion. It's not even a question. See, that was very original thinking when you said that when a person travels from one state to the other state and then there's a hotel bill on him and CGST is raised, and of course ITC cannot be claimed. And your thought was, why not the CGST portion alone can be claimed as ITC in his state? That's a very, very original thinking. But don't you think it hits at the scheme of the act? I mean, it's just a thought that it rose in my mind. Don't you think it will hit at the scheme of the act?
It should, as far as NGST is concerned, but CGST revenues anyway go into CGST coffers. It goes to the Finance Commission for distribution. And therefore, it is still a central government revenue without an iota of money being shared with the states in the GST route. It goes only to the Finance Commission route. And therefore, if earlier days when I had excise, we had this problem with specific factories and we had this unit-related restrictions. But having opened up and said everything is across the country, at least somewhere in CGST we should look at it. Probably law will evolve. Just a thought that
it has to evolve. It has to evolve because right now, I don't think, even forget the portal. Portal is just a procedure. But I'm talking about the scheme, whether it will be workable. It's a beautiful thought. But then it has to be, as you say, it has to evolve. It's a very wonderful thought, actually.
Thank you.
Because I was really wonderstruck by the way you've thought on that. I didn't think on that. Yeah.
Thank you very much, ma'am.
Yeah.
Mr. Saravana?
You need to unmute.
Am I audible now, sir?
Yeah.
Yes, Mr. Saravana.
So thank you, sir. It was a pleasure listening to you again. I heard you, listened to you yesterday as well, your session. Again, continues today. It's been quite a pleasure. My questions are twofold. If I may, the first question is with regard to ITC eligibility on e-bikes. Question number one. Question number two is prepaid expenses. That is an expense for a particular service which is spread across 2 years. So when would the ITC eligibility arise? Can I claim the entire ITC in the first year, or should I wait till the entire service is received and claim it only the second year? So two questions, sir, if you may.
See, let's look at it from government's perspective as well as what the law talks about. When they say used and intended to be used, I don't think they are having any kind of restrictions by a fiscal year or a period. They go beyond that. So I should be able to demonstrate that I've procured it and I've received an invoice. As I said, it will be a challenge for services if somebody goes deeper down the road and say, demonstrate that you've received the services. How do you demonstrate that you've received the service? Or for that matter, if you don't like the service, you can't even return the service. At least goods, if you don't like, you can return the goods. If I provide this, let us say I take our lawyers, we give our legal opinions. And most of the time, we like our legal opinions, but client may not like it. And if the client is not happy with the opinion, he may say, I am not going to pay you fees and I am going to return the opinion. What is the purpose? There's no purpose. So service is very different. So we'll have to perceive services differently. And if you perceive in that perspective, so long as you have procured the service, even though it's spread over a period of time, you should be able to claim the credit.
And first is regarding e-bikes, sir.
E-bikes?
Yeah.
What is e-bikes?
E-bikes are electronic bikes, which they are proposing to bring into India as well. It is spread. It is already available in many other countries, but electronic bikes.
They were talking about taxing e-bikes.
No, ITC on e-bikes.
You have to decide whether it is goods or service or both. Now, you have to, if you go by the, in fact, somebody asked me a question somewhere. Sir, goods is defined, service is defined, both is not defined. Why is both not defined? So it made a very interesting question as to whether both is a species by itself. Because goods or services or both, that's how it is reading as far as even the constitution itself. But I would go by this. If the distinction between tangibles and intangibles, you have enough of jurisprudence in the pre-GST law. We even have, if you read Yash Overseas Supreme Court judgment, in the context of exempt scripts and DPP and REP, the last but one paragraph, my memory could be wrong, the last but one paragraph says that even airline miles, if they become transferable, can become goods.
Yeah.
Therefore, if something you're able, or your Sorexo versus in the context of the Supreme Court when they said it is an actionable claim. Now, all that is lost because actionable claim is defined within the ambit of the goods. So, the GST is probably an amalgam of all those decisions and principles into the definitions. And therefore, you should be able to peg e-bite into either goods or service depending upon how it is. And if you're able to procure it, you should be able to get it. In fact, I will take and this opportunity, since very rare to get all tax professionals in one platform. Forgive me, Jayakumar, if you feel there's misusing this platform. But I've just now finished and released a book called Taxation of Digital Economy. And it had just come out in March, and therefore people have not been able to go to their bookstores to buy it. And therefore, I've also made it available in the online format. If you get that book, you will get a lot more answers. There are judgments in Europe as to whether digital lending of books is the same as book lending. There are a lot of interesting observations in that. So this is in the context of PE as well as GST.
Thank you very much, sir. Aparna ma'am, you wanted to continue or supplement?
Yeah, someone else has a question. I have something else to discuss, but I don't want to be the only person asking.
I see Vijay Kumar there. I saw his hand.
Vijay Kumar wanted to ask a question.
Yes, there are 2-3 more.
Hello, Vijay Kumar. Sir, Mike.
Vijay Kumar, sir?
Yes, you are able to hear me?
Yes, sir.
Yes.
Sir, how are you? After a long time, you are able to see through that video conferencing. Sir, I have just a question about the limitation of claiming ITC.
Right.
One is, I am a purchaser. My seller registration was cancelled because he is not continuously filing 6 months return. But after that 6 months period, that registration cancel was challenged before the appropriate forums. Now my GST returns are rejected on the ITC. Was there any possibility to reject my claim of ITC?
I doubt if they can proceed those lines because there are enough judgments of the court, including Lordship Justice Singhanam on this, where at the time of procurement, if your seller was bona fide and his registration was valid and he has raised the valid sale invoice, subsequent cancellation of registration cannot be the basis for denial of VAT credit. There are a series of judgments.
Yes, under the VAT Act, so many judgments are there. But under the GST Act,
you will have to only deal with section 16.4. You will have to, you may encounter some kind of rough weather in the context of 16.4 based on when you have made the claim. If your claim has been made within the time under section 16.4, then if you look at section 16.2, I again repeat section, I would request Mr. Vijaykumar also to read section 16.2 in depth later on. They've used the word a person claiming ITC. The word used is he. He is in receipt of an invoice. He has received the goods. He has filed the return. So he, in my view, can be only the purchaser and not the supplier. You can't suddenly shift the law and say supplier should file the return. So if you read it in full, you will get the picture that so long as a purchaser you have filed a return, you should be able to claim it.
And followed by that question, my seller whose registration was cancelled, he filed in the appellate forum. After a period of 1 year, he succeeded and his registration was restored. What is the liability for paying interest on that?
Interest on
claiming? Yes.
We'll chat separately.
Because now he is allowed to file returns. After now the registration has been restored.
Well,
now he is allowed.
Sir, I would answer this like this. If the registration was restored and the
yes.
reason for the registration given by the restoration is given by the court as saying the original cancellation was illegal or the original cancellation was not in accordance with law, then you can take a stand that the department cannot take further advantage of an illegal action. You can read a decision of the Supreme Court in the case of Quail Fireworks in excise. In Quail Fireworks, what happened was there was a small scale unit. I mean, there was a crackers manufacturing unit. And at that point of time, there was a notification which said that if you manufacture crackers without the aid of power, you will qualify for exemption from excise. So this company said that we are manufacturing without the aid of power and they cleared the goods. There was a suspicion that they were using power and therefore there was a raid and the goods were confiscated. Subsequently, the goods were released on the ground that there was nothing wrong. Now, unfortunately, when the goods were released and the assessee was removing the goods from the factory, the original notification had expired and any removal attracted duty, this exemption was not applicable. So the department demanded excise duty saying that forget all the old story. Today you are removing goods. These goods now attract duty because at the time of removal, there is no exemption. So Supreme Court applied principles of equity and said that the department cannot take advantage of their own illegal action and demand it. Probably try to draw an inference and see what it can.
Right. Thank you. Thank you, sir.
The ITC element, suppose the registration is restored, and what would happen to the ITC element? That is also a position that has to be seen, isn't it? Because that 1 year period has already expired.
Yes, that is another followed that problem.
If he had availed earlier, he would be fine. But if he is waiting for everything to be restored, then he would be hit by section 16.4. He has to navigate 16.4. And there are arguments in 16.4, whether GST R3 is referred to or 3B is referred to. Those are different.
That issue is definitely there, yes.
Thank you, sir.
Thank you, sir.
Someone else has asked.
Sir, with your permission, sir, there are 2-3 more questions, sir, subject to your...
Yeah, Prithvi, go ahead.
Yes, sir, thank you, sir. So, one Mr. Mukul has been asking questions from the beginning of the session. So, I thought he's been asking. Mr. Mukul?
Yes, I'm here.
Yes.
Yeah. Sir, I had 2 queries. One query was on reversal of input tax credit. I have claimed some credit, wrongly reversed it, and subsequently, can I claim the credit anytime later, or will it be subjected to the time limit of 180 days for reclaiming? The second question is, can I claim input tax credit on two-wheelers used for transportation of goods?
As far as the first question is concerned, there are two answers to it. One is in the context of SENVAT credit rules. When the time limit was first introduced, the board issued a circular to say that if you had reversed it and then you claim back the credit again, you will not be hit by the time limit. There was a board circular. Second is there is a decision of the Madras High Court by Lordship Justice Chitra Venkatraman, ICMR or something, ICME or something, where Madras said that recredit is just an accounting entry. It is not amounting to taking credit. Somebody has reversed it, he's taking back the credit, and there's nothing wrong in treating it differently. ICMC, right, Nataraj?
Thank you, sir. See, the second question was with regards to whether am I eligible to claim credit on purchase of two-wheeler used for transportation of goods, like a TVS motorcycle that comes with one single seat.
This requires a journey which I'm not able to do now, because motor vehicle you have to see. Then motor vehicle definition, the GST Act you have to see. If motor vehicle definition has borrowed Motor Vehicles Act definition, you have to go to Motor Vehicles Act and see motor vehicle. Probably we'll catch up sometime when COVID is over and I'll give you my answer.
Thank you, sir. Thank you very much.
Thank you, Mr. Next, Mr. Jiten.
Hello.
Yes, Mr. Jiten.
Sir, good evening, sir. This is Jitendra Kumar. I have one doubt with regard to 16.2, non-payment of value of supply. There is a company which has issued a credit note, commercial credit note, not a GST credit note. Hello, can you hear me, sir?
Yeah, I can hear you. Please.
Yes, sir. There is a company which has issued a commercial credit note, and to that extent, my books have been adjusted such that the payment has been made to the value of that commercial credit note. Can now department come and say that it is a non-payment of value of supply, and will they ask me to reverse the credit under section 16.2?
I have a doubt, because when you have a manufacturer who has made let us say an invoice for 1,000 rupees and charged 18% GST, and subsequently market factors, he issues a commercial credit note for 200 rupees and does not bother with the GST. He doesn't follow section 34. He doesn't follow section 15. He decides to issue a financial. And buyer has already availed that 180 rupees ITC, and the value has now come down in his books by 200 rupees. Purchase value has reduced in his hands. Now, can you compel the recipient to reverse the ITC? My answer is no, because you go to VAT. 1920 was specifically enacted for this purpose. Section 1920 of the T and VAT Act very clearly said that when the selling value is, the purchase value is higher than the selling value, then your proportionate ITC will have to be reversed. And 1920 was brought after some time when VAT came into force. And finally, matter landed before the Supreme Court, and Supreme Court said that the amendment is only prospective and not retrospective. There is no similar section like 1920, either in the entire 16 subsections or anywhere else, or in 17. And therefore, in the current legislative mechanism, it's difficult to envisage such a situation. Nor do I foresee something like that in the future, because my experience is that amending CGST Act is the biggest challenge today. If you have to amend CGST Act, it is such a big challenge, because after that, 29 states have to amend their SGST Acts, and only after all of them amend, you have to notify the date. And that becomes a huge challenge as to which section has come into force from which state. So going forward, any touching the legislation is going to be a challenge.
So the book adjustment, which with regard to commercial credit note, is as such as payment has been made, right, sir?
Correct.
Yes. Okay, sir. Thank you so much, sir.
Thank you, Jiten. Sir, Jaykumar sir has few queries, sir. Jaykumar sir.
Yes, thank you. Thank you, Vaidhi. What a wonderful presentation. In fact, it is worth the Silver Jubilee. And I didn't know it was a Silver Jubilee, but it is a very fitting presentation. In fact, like every time, you surprised me with your 16.2D, the way you explained that I was always under the impression that he is only the supplier, because receiver I never able to conceive, because that could not be a condition. I don't know what it is imposing, but still you gave a very clear explanation, because when we read he from the beginning, this should also be only the recipient, not the supplier. Reasons notwithstanding, you broke one of the myth, what I was always having it. Likewise, your explanation to 17.5, that H on the Gibbs, the explanation of donor-donee was also fabulous, groundbreaking, fantastic, thank you. But in 17.5H, I have one more doubt. See, it says simply that goods which are lost, stolen, destroyed, disposed, or written off or exempt, or blocked credits. Now, whether for example, I'll take a manufacturer and a trader. For a manufacturer, whether this goods means his inputs or his final products. For a trader, it is one and the same because he is only going to trade the goods. Meaning, for a trader, it is his trading goods, then there is no problem in understanding it. But for a manufacturer, if I am able to understand it is goods, finished goods which are lost, or should I understand the inputs which are lost? I just want you to throw light on that.
You raised a good point. It's like this. The problem arises because of the fact that GST credit is largely governed by the Act and not the rules. If it had been the rule, they have probably inserted one more proviso or sub-rule to cover all kind of scenarios and variations. But let us look at it the way entire flow of 17.5 is concerned. Entire flow of 17.5 is in the context of the person availing input tax credit. You cannot claim ITC, you cannot claim on this, you cannot claim on input. And therefore, when goods are referred to, lost, destroyed, or disposed of, or otherwise, etc., is used, it cannot cover finished goods. Now, let us assume it covers finished goods. And I have output stock in my factory. I'm yet to remove them. And thanks to COVID, I'm not able to remove it at all. And these goods become condemned and damaged, and therefore I destroy it. Now, if I destroy my output, where is the mechanism to identify the input sitting in that output to reverse the credit? There is no mechanism, there is no formula. Whereas if you go back to SENVAT credit rules, in a situation where a final product was taxable and subsequently became exempted, there were sub-rules which said that the inputs as well as the inputs in stock, inputs in work in progress, as well as inputs sitting in finished goods will have to be identified and reversed. So there were specific provisions which addressed what all inputs that go into the output. Now that kind of language you don't see in 17.5 at all. Therefore, you would have to read it as this is meant for inputs. Therefore, for a trader, as you rightly said, there can be a problem because what he buys is inputs for him. Whereas for a manufacturer, it may be possible to state that you cannot bring this theory to your output.
Okay. The second and the last question would be, see this ocean freight, that service tax on ocean freight, which happened very near to the GST implementation. Many of our people, understood there issued notices or even letters, and some of them, decided to pay the tax. But it was a service tax which was paid. But the issue itself started only very close to GST, and so it progressed so much, thereafter, beyond the transitional date. So now everybody is stuck that they are willing to pay the service tax on the ocean freight. It is an eligible input tax credit, or even before it was an eligible SENVAT credit. Now, with this transformation from GST, to GST, when the tax becomes payable, or even the department understands only it was taxable only after post GST, and it was made to be paid, do you see that there is a redressal for taking the credit under the GST regime, still in the nature of service tax, the ocean freight? What would be your call?
I will give two answers to it. One is, of course, I've initiated a set of writ petitions before the Madras Court, and it was also posted for hearing just around before COVID, and finally it didn't happen because COVID happened. Okay. But we have questioned the levy of service tax on ocean freight on the premise that when the service provider, which is, let us visualize a situation where there is a supplier in the UK, and he's supplying the goods to me on CFR or CAF basis, and the UK supplier engages a shipping line, let us say NYK shipping line, and the ocean freight is a transaction between a Japanese company and a UK company. So when the service provider and service receiver is completely different and outside India, how can you make an importer liable to pay service tax, and whether that kind of power is available was the question before the courts. Gujarat High Court has given a favorable judgment, and we are also in red before the Madras High Court. And we also challenge the IGST on ocean freight in post GST, because post GST is more interesting because there is a definition of recipient, and the RCM mechanism under the GST law empowers you to impose GST only on the recipient. Therefore, one route would be a challenging route or a litigious route. The second route would also be a litigation route, because if you decide to pay the service tax, there is no way you can claim your credit through any of the existing mechanisms. Therefore, you have to seek a direction to be allowed as a credit as part of transitional mechanism, which would be a very far-fetched prayer, can be a huge challenge. One can probably look at the decision of the Telangana High Court in the context of Justice Ramswaran judgment in the context of VAT, where what is the GST and VAT, where it so happened that the company had a problem because of the reorganization of states. So the AP and Telangana got created, and therefore they had VAT credit in AP, which should have been allowed naturally as Telangana VAT credit. But unfortunately, that amount did not get transferred to Telangana VAT credit, and in the meantime, GST happened. And therefore, the assessee said, I would like to claim it in Tran 1 and claim the credit in Tran 1. The department argued saying that, no, you can't claim it under Tran 1 because this is not covered under the normal mechanism through which Tran 1 credit can be offered. But Justice Ramswaran said that you must have purposive interpretation of the provisions of transition. And there is nothing wrong in giving credit through Tran 1 as far as this is concerned. Either way, you are agreeing that you're going to give it as refund. So if you're going to give it as refund, there is nothing wrong in giving as Tran credit. Wonderful. And there are also some other judgments in the context of GST also in Delhi High Court, where they try to give you as credit instead of refund. So you may have to try to seek that kind of a relief. But first round would be a better round because you're questioning the levy, and therefore you may not pay the tax. And if you had paid the tax, you may probably have a better chance for refund. The second round, where you pay the tax and you're saddled with not able to take credit, might be a cost factor from a business perspective.
Thank you. Thank you very much.
Thank you, Jayakumar sir. So there are a number of...
Is that Purushottam?
Yes, sir. Sir, there are a number of questions which are constantly coming up in line, sir. But subject to your convenience, sir, we can take up a couple of more questions, or
maybe we can wind up with one or two and close it. It's already 6:30.
Yes, sir. Sure, sir. Sure, sir. Yes, sir. Yes, sir. So, Mr. Veera Raghavan.
Sir, good evening, sir. My name is Veera Raghavan.
Yes, sir.
It was a very enlightening presentation, sir. My question is with respect to the ITC on the services that have been availed by the hotels. Now the situation is that hotel services should pay tax at 5% provided they do not avail any ITC. Now, in cases where I provide a bundle supply, which involves accommodation as well as a supply of food, now should I raise a single invoice? And since my principal supply, I could interpret it by saying that it's only accommodation, can I take that route and avail ITC on the food products that I have availed as well, making that bundle supply?
But are you extending your ITC only in the context of food for the person staying in the hotel, or even guests who are coming and eating in the restaurant? That might be the tricky.
No, it is open for all, sir. No, in that case, I would have a separate bill. Okay.
A better route for you would be to whether you can interpret the notification which talks about 5% as a conditional exemption. In which case, at least you can go to the full route and pay the full rate and take the ITC. There are enough decisions saying that if it's conditional, you can choose to ignore the condition. Because a rate notification cannot prescribe a condition. If that is the case, none of the notification would refer only to section 5 or ITC. They refer beyond that. They refer to 11. They refer to 15. So therefore, you have to look at a combination of so many notifications. With a bundle of conditions, you can always choose to ignore those conditions, despite their explanation in that notification.
Okay, sir. Now that this jurisprudence of this composite and mixed supply, taking more prominence under the GST era more than the previous indirect tax era. I think this will be a very moot point to consider for all tax consultants. My hotel was just an example. Now I can bundle any number of service. If I'm a bundled service provider, I can bundle any number of service and might take an umbrella under any of the principal supply and say that I can avail ITC on whole of the products that I'm actually buying or services I'm procuring.
You're right. Composite and mixed supply is going to be the bone of contention across the next few years, because see, business itself is a commercial transaction. It is not primarily driven by tax. Many people think that tax only drives business, but business drives by itself. Why I want this along with that? Why do I need X along with Y? Why is Y imperative for X? These are all business calls between the parties concerned. So when a law tries to get into business and define, for example, the composite supply definition is partially borrowed from Europe, but it's only partially borrowed. If you take the European law, they say that value will be treated differently, rate will be treated differently. They don't bring a principal supply concept. So the principal supply concept does exist only in the Indian law. So what is a principal? Let us assume there are equally competing supplies. One is equally competent to the other supply. Then I can very well say that it is neither a composite nor a mixed supply. See, it is not a mixed supply because you don't have a single price. It is not a composite supply because I have more than one principal supply. Then I walk out of both these definitions.
Okay. Okay, sir. Thank you so much. Thank you, sir.
Welcome, sir.
Thank you very much, sir. So I think we can call off this because we have already exceeded beyond our time, sir. Yes. Sir, with your permission, sir, I have got...
Yeah.
Hello? Yes, sir. So with your permission, sir, I have been getting requests if your presentation could be shared, sir. So if you permit, sir, then I can probably forward the PowerPoint presentation which you have shared in this session, sir.
Just convert the PDF and share.
Yes, sir. Yes, sir. I will make that. I'll convert it into a PDF and I will share it with your permission.
Let me thank the organizers. It's been wonderful that I'm able to see so many friendly faces. It's been ages since I caught with some people, and it's so nice to see them. And thank you for giving this opportunity.
Thank you very much, sir. Jaykumar, sir, you can.
I want to add a word. Vaidhi, I think you should be remembering that I invited you to Coimbatore.
Yes, I remember, Jaykumar. We'll remember the next time I catch you in Coimbatore.
No, what happened is that chamber secretary spoke to me. First, he asked me to present. I said, I wanted you to come. Then he asked me, you are Rajinikanth. Why you want him? I said, I may be or may not be Rajinikanth. But heart to heart, Rajinikanth knows Kamal is always a better actor. You are always a better You are always a better actor and once again demonstrated. Thank you, Vaidhi. Thanks for accepting the invite and coming. Thank you. We are all privileged. Thank you. Thank you, Prithvi.